Okay, all right. Good afternoon, everybody, and thank you again for attending my class. Today, we're going to start a new chapter, chapter 23, that is flexible budgets and standard cost system. Well, in the previous chapter, we learned about the master budget, right? That is the static budget. You remember the purpose of preparing a budget. The purpose of preparing a budget is to make comparison between actual performance and the budgeted performance. So in this chapter, we will learn how to make this comparison, how to make analysis of the difference between our budgeted performance and the actual performance. So let's take a look at the learning objectives. We have 6 learning objectives. First, prepare flexible budget. Second, to identify the benefits of a standard cost system. Next, to compute the standard cost variances for direct material and direct labor. Next, in addition to direct material and direct labor, we have the manufacturing overheads as another part of the cost in the cost of the product. Lastly, we're going to learn how to describe the relationship among the responsibility for product cost variances and to record transactions in the standard cost system and to prepare the standard cost income statement. Okay, let's get started with the introduction of preparation of flexible budgets. Previously, we discussed how managers use budgets for planning and controlling the business activities. In the previous chapter, we learned about the master budget. Master budget focuses on the planning step. But in this chapter, we'll focus on the controlling step as we look at the decisions managers make during and after budgeting periods based on the actual performance of the business. Managers, based on the actual performance, may ask 3 questions. 1. Did my division meet its sales goals? Second, have the cost increased? Third, sales have dropped. So how do we need to adjust the spendings? In addition to these 3 general questions, well, the managers also need to investigate the difference between the cost as well as the efficiency of the usage of direct material and direct labor. Businesses often have to make difficult decisions. And for example, in an economic downturn or increased competition may cause a decrease in sales. In such a situation, spending must also decrease in order for the company to remain profitable. So basically, this slide illustrates the budgeting objectives discussed in the previous chapter. First, we make the budget. And based on the actual results, we compare the actual results with our budgeted amount. The amounts listed in the budget. Well, based on this comparison, we decide which part is favorable and which part is not favorable. Or in other words, which part is we were doing good, better than we expected, or worse than we expected. So based on this comparison, we make analysis. And based on the analysis, we control for this difference. If we see, well, this part we're doing better than the budget amount, what can we continue to do to make this much better? And if we're doing worse than our expectation in the budget, we can see what can I do to remedy this worst part to make it better. So let's see before we get to know the flexible budget, let's see some key concepts. A static budget is a budget prepared for only one level of sales volume. So the master budget is a static budget, which means it is prepared for only one level of sales volume. Do you remember in the previous chapter, we make the master budget depending on only the one level of sales volume. But actually, we will also need to make the budget for different levels of sales volumes, because this sales volume can be difficult to be predicted correctly or exactly. And next, a budget performance report. As I said, the usage of budget is for managers to make performance, to make comparison between performance. Oh, well, Chihaki Uka, how many pages does the midterm have to be? Well, can you hold this question after the class? And right after the class, I will respond to all the questions regarding to future homeworks or assignments, okay? Okay, let's continue. Where am I? Well, a budget performance report is used to make comparison between the actual results and the budgeted results. So it is a report that summarizes the actual results, budgeted amounts, and the differences between them. So next, we look at the differences between actual results and budgeted amounts. Here, in managerial accounting, we call this difference as variance in terms of budget controls. So a variance is the difference between an actual amount and the budgeted amount. A static budget variance is the difference between actual results and expected results in a static budget. So here, generally speaking, the static budget refers to the master budget. So when we look at the variances, there are two categories in general: favorable and unfavorable. We could say a favorable variance is an actual amount increases operating income. So generally speaking, to determine the amount of operating income, two things you need to look at. First, the revenue. Second, the expenses, including the cost. So, in terms of revenue, if the actual revenue is greater than budgeted revenue, we say, well, this is favorable because the actual revenue is greater than budgeted revenue. That is the income source of your money from your sales of products. And if the expense, let's see, expense, if the actual expense is less than budgeted expense, well, typically that is a good thing for a business because you spend less money to make your products. So if actual expense is less than budgeted expense, we say, well, this performance is favorable. And inversely, if actual revenue is less than budgeted revenue, we say this is unfavorable. If actual expense is greater than budgeted expense, we say this is unfavorable. So in this part, we use a uppercase F to indicate, well, this variance is favorable. And we use uppercase U to represent unfavorable, showing, well, this actual result is unfavorable. So in this chapter, we use another fictional company called Cheerful Colors as an example to illustrate the points in this chapter. The variances in this slide are called static budget variances. A static budget variance is the difference between the actual results and the expected results in the static budget. This company's static budget variance for operating income is favorable, primarily because the company sold 52,000 batches of crayons rather than 50,000 batches, which is the amount in the budget. But there is more to the story. A static budget performance report is useful in evaluating a manager's effectiveness when the actual level of sales closely approximates the budgeted amounts. It is also useful in evaluating the manager's ability to control fixed manufacturing costs and fixed selling and administrative expenses. A static budget performance report is not helpful in evaluating variable costs because as production changes, variable costs should also change accordingly. So this company needs a better tool to examine the budgeted income at different sales levels. That is called flexible budget. So as we can see in this static budget performance report, we list the difference between budgeted amount and the actual results in another column. That is called the variance, static budget variance. Well, again, static budget variance shows the difference between actual results and static budget. First of all, let's see the sales. In the static budget, the expected sales amount is 50,000. But actually, the actual results may the sales of 52,000, which is greater than the budgeted amount. 2,000 greater than budgeted amount. So the difference between static and actual results is 2,000. 2,000 more in sales, which means we sell more products than we expected. So this 2,000 is favorable. Definitely in the business, the managers want to sell more products than expectation, right? So this difference is favorable. We write F in this column, this F. And let's make some other examples. Let's look at some other examples. For example, the sales revenues. Sales revenue is determined based on the units sold. Units sold times unit price of each product equals sales revenue. As the sales units increased by 2,000, the sales revenue also increased accordingly. That is the unit price times 2,000. So the variance for in terms of sales revenue is 9,800. An increase in revenue causes an increase in operating income. So this is marked with F, which stands for favorable. Well, Next, let's look at another unfavorable part. Well, for example, direct materials. The cost of direct material in static budget is only 87,500. But actually, the actual results shows the usage of direct material more than expected. That is an increase in the cost. An increase in cost is not favorable. It will result in the decrease of operating income. So the difference between actual results and budgeted amounts in direct material is 16,500, which is unfavorable. So here we use an uppercase U to indicate unfavorable results. Unfavorable results would decrease the final operating income. So we learned about static budget. Next, let's look at what a flexible budget is. A flexible budget summarizes revenues and expenses for various levels of sales volume within a relevant range. The K is various level of sales revenue. Do you remember in the previous chapter, we look at one level of sales revenue. In this static level of sales revenue, what would the budgeted amount of, for example, direct material, direct labor, and the expenses, some other things, including the financial statements, what would these things look like? In this one level of sales volume. But a flexible budget summarizes the revenue and expenses, well, including the future financial statements at various level of sales volume within a relevant range. Flexible budget separates variable cost from fixed cost. The variable cost would flex in flexible budgets. To create a flexible budget, you need to know the following, including budgeted selling price per unit, budgeted variable cost per unit, total budgeted fixed costs, as well as different volume levels within the relevant range. So next, let's look at an example of flexible budget. This slide is a flexible budget for careful colors, revenues, and expenses that predict what will happen if sales reach 48,000 batches. 50,000 batches or 52 batches of crayons sold during 2019. This part is static. The budgeted sales price per batch is $7.50. Budgeted variable costs are $1.75 for direct labor, $3 for $1.75 for direct material, $3 for direct labor, and additionally 75 cents for variable manufacturing overheads, and another 5% of sales as the supply cost. Budgeted fixed cost stays the same at each level of sales. I mean this part. This part stays at a static level horizontally. By saying horizontally, I mean at various level of sales. And let's look at the difference. The difference is this part. This part in blue stays variable horizontally, simply by multiplying the unit cost or the unit selling price by different sales level. 48,000, 50,000, or 52,000. Note in this slide that the sales revenue, variable cost, and contribution margin increase as more batches of crayons are sold, but fixed costs remain constant regardless of number of crayons sold within the relevant range of 48,000 to 52,000 batches. This is an important distinction to remember about flexible budgets, because total fixed costs remain constant within a specific relevant range of output. Fixed costs do not change on a flexible budget. Variable costs in total do change, but the variable costs in terms of unit cost do not change. It is not enough to know that a variance occurred. Managers in the business must know why a variance occurred in order to pinpoint the problem and take corrective actions if it is unfavorable. As you have noted in the previous slide, the static budget underestimated both sales and total variable cost. These differences are caused by two primary factors. there is a difference in price or cost, or there is a difference in volume. Again, two factors. Any of these two factors changes could result in the changes in the actual results, which is different from the budgeted amount. First, a change in price or the cost. And second, the difference in revenue. To develop more useful information, the managers divide the static budgets into two broad categories: the flexible budget variance and the sales volume variance. The flexible budget variance is the difference between the actual results and the expected results in the flexible budget for the actual units sold. The sales revenue variance is the difference between the expected results in the flexible budget for the actual units sold and the static budget. So this slide is more straightforward to show this point. Again, the variance in static budget consists of two parts. The variance could be attributed to flexible budget variance, or which shows the difference in price or the cost. And another attribution is a change in sales volume. This slide is this company's flexible budget performance report for 2019. Recall that the variances in the second and fourth column are favorable if the actual amount increases operating income, or unfavorable if an actual amount decreases the operating income. So let's take a look. A comparison between column 1 and column 5 was showed in the previous slides. A comparison, right? A comparison between actual results and static budget. The direct comparison between these two columns are shown in the previous slides. But in addition, we also have to compare the actual results between the amounts between actual results and flexible budget. Flexible budget shows the expected amounts at a different sales level. Column 1 of the performance report shows the actual results based on 52,000 batches of sales. These amounts were originally shown in the previous slides and are not based on the budgeted amounts per unit, but are the the actual operating revenues and expenses for this period. Actual operating income is $36,320 for 2019. Column 2 is the flexible budget variance and shows the operating income is 680, less than the company's expectation of 52,000 batches of crayons sales. Managers want to know why operating income did not match the flexible budget. Column 3 is the company's flexible budget for the 52,000 batches of sales, which is the actual sales volume. Operating income should have been $37,000 based on that level of sales. Column 4 is the sales revenue variance. The differences arise only because Cheerful Colors sold 52,000 batches of crayons rather than the 50,000 batches it planned to sell. The last column gives the static budget for 50,000 batches expected to have been sold in 2019. Cheerful Colors budgeted earnings of $33,750 before the budgeting period began. So this is the meaning of flexible budget and static budget. Again, flexible budget predicts the operating income in another level of sales revenue. Rather, static budget predicts the operating income in only one level of sales revenue. The difference between flexible budgets and static budgets is the total amount of variable part, either variable sales or variable cost. The unit price, for example, the unit selling price or the unit cost for direct material, direct labor, or manufacturing overhead stay constant within this relevant range of sales. Well, can you go back 2 slides, please? The slides with flexible budget. You mean this one? Okay, I can open the microphone for you. Join. Yes, you can speak now. Yes.
Yes,
I can hear you.
not that slide, the one with the flexible budget, the one before that one.
Let's see. This one?
No,
This?
no, go back.
This?
Yes, that one.
Oh, okay. Yes. What's your question?
So you see that the one with the flexible budget performance report, those numbers, the ones that you are highlighting with the blue, those numbers are which column?
Oh, the numbers highlighted in blue. Okay, these numbers is the unit price times times the sales volume. For example, 3600,000 is this number times this.
Oh, okay, I got it.
And this one is sales price times this level of sales. And this number is $7.50 times this level of sales. And this is sales revenue. It is also true to manufacturing overhead, which is variable cost. This is all variable. Do I answer your question?
Yes.
Oh, okay, very good. You're welcome. Well, any other questions? Oh, yes, Neil, Peter. Do you have any questions? Nope? Good. Let's continue to the next learning objective. To identify the benefits of a standard cost system and understand how standards are set. Okay, most companies use standards to develop budgets. A standard is the price, cost, or quantity that is expected under normal conditions. For example, based on the previous slide, cheerful colors expects the direct material to cost $1.75 per batch of 100 crayons. Therefore, the standard cost for direct material is $1.75, and that was the amount used to develop both the static and flexible budget. The terms standard and budget are sometimes used interchangeably. However, a budget amount generally indicates a total amount, whereas the standard amount is a per unit amount. In the case of direct material, the standard is $1.75 per batch, and the budgeted amount for 2,000 batches, for example, is $91,000. Again, let me write it. The standard cost for direct material is $1.75. These amounts, well, can be found in the previous slide. That is this one. You see the standard for direct materials right here. The number highlighted in green is write the standard cost for direct material. And it is carried in to the next slide. This is the standard cost in terms of direct materials. And we use another term, budget, to indicate the total amount. For example, here, we times the standard cost for direct labor by 2,000 batches. So the total budget for direct material is $91,000. The company uses a standard cost system, which is a accounting system that uses standards for product cost, including direct material, direct labor, and manufacturing overhead. Each input has both a cost standard and an efficiency standard. For example, this company has a standard for the cost it pays per pound for wax. This determines the cost standard. The company also has a standard for the amount of wax it uses for making the crayons. This determines the efficiency standard. So this is a summary of cost standard and efficiency standard. Cost standard, well, it is pretty much straightforward. It means, let's see. I had a question about the midterm. Oh, okay. I will explain all the questions regarding the midterm after the class, okay? Well, let's continue. Cost standards primarily means the unit cost for direct material or direct labor or manufacturing overhead. And the efficiency standards primarily regarding direct material and direct labor means how efficient is direct material or direct labor are used. In terms of direct materials, we could ask whether the workers on production line waste the materials. For example, in this company, we can use 1 ton of wax to make 100 batches of crayons. A high usage efficiency of direct material means we make more batches using this 1 ton of wax. A low efficiency of usage of direct material means we make less than 100 batches than expected. And that is same thing for direct labor. This slide computes This is cost standards for direct material, direct labor, and manufacturing overhead based on the static budget of 50,000 batches of crayons. The manager in charge of purchasing for the company indicates that the purchase price net of discounts is $1.65 per pound of paraffins. Delivery, receiving, and inspection at an average of 10 cents per pound. That is 1 cent, $75 per pound in total in terms of direct material. Next, let's see the direct labor. The company's hourly wage for a worker is $10, and the payroll tax and fringe benefits total $2 per direct labor hour. So that is $12 per direct labor hour. Variable manufacturing overheads will total 37,500 based on 50,000 batches of crayons. Flexible manufacturing overhead is 25,000 and overhead is allocated based on 12,500 estimated direct labor hours. The company has analyzed the manufacturing progress and has set efficiency standards. Production manager and engineers set direct labor, direct material, and direct labor efficiency standards. Efficiency standards are also called quantity standards or usage standards because they are a measure of how much input should be put into the manufacturing process. In other words, if the employees are working efficiently without spilling or otherwise wasting materials, how much paraffin should the company put into each batch of crayons? The output. That amount is the direct material efficiency standard. To set labor standard, the company can analyze every moment in the production process and then take steps to eliminate the inefficiencies. For example, to eliminate unnecessary work, machines can be rearranged for better workflow and less material handling. Companies can also conduct time and motion studies to streamline various tasks. For example, a plant can install a conveyor at waist height to minimize bending and lifting. Companies often develop efficiency standards based on best practices. This is often called benchmarking. The best practice may be internal benchmark from the other plants and division within the company. So it may be an external benchmark from other companies. Internal benchmarks are easy to obtain, but managers can also purchase external benchmark data. Manufacturing overhead is allocated based on direct material hours, and the efficiency standards for expected direct material hours has been established. So no additional efficiency standards are required for manufacturing overhead. Okay, generally speaking, the standard cost helps managers first to prepare the master budget to target levels of performance for flexible budgets, to identify performance standards, to set sales price of products and or services, and to decrease accounting cost. So this slide shows the causes of the flexible budget variance. Primarily, the causes of this variance of flexible budgets are attributed to two parts. First, cost variance. Second, efficiency variance. To calculate the cost variance, we use the actual cost less standard cost. And to calculate the efficiency variance, we use standard cost times actual quantity minus standard cost times standard quantity allowed. Well, to compute the cost variance, we use actual cost times actual quantity less standard cost times actual quantity. Okay, let's take a look at the cost variance. Again, cost variance measures how well the business keeps unit cost of material and labor inputs within standards. The cost variance is the difference in cost of an input multiplied by the actual quantity used of the input. This is the calculation of cost variance. We use actual cost minus standard cost, and the difference, we use the difference times actual quantity. Efficiency variance, again, measures how well the business uses its materials or human resources. And this is the calculation. Standard cost times actual quantity less standard quantity. We use the difference between these two amounts times standard cost. We get the efficiency variance. So, overall, we can attribute three parts to static budget variance. This slide shows the relationship among variances and how to separate total flexible budget variances for material and labor into cost and efficiency variances. And this slide emphasizes 2 points. First, the cost and efficiency variances add up to the flexible budget variance. Second, the static budgets play no role in the cost and efficiency budget. The static budget is used only to compute the sales revenue, the sales volume variance. The variance caused the company sold a different quantity than it thought. It is never used to compute the flexible budget variance or the cost and efficiency variances for material and labor. So this is the final part of this class to compute the standard cost variances for direct material and direct labor. Now we will return to our example. The previous slide shows several substantial flexible budget variants, including some unfavorable variance for direct labor and some variable variance for the favorable part for direct material and unfavorable variance for direct labor. The unfavorable part for direct material and favorable part for direct labor, as well as favorable part for variable overhead. And this slide summarizes the flexible budget variance for production cost. Both favorable and unfavorable variances should be investigated if they are substantial. They are investigated to determine their causes. As an example, the company avoided routine maintenance on machinery in order to have a favorable cost variance in the current period. But in the later period, the company could have a major breakdown that would have been avoided if the machinery had been properly maintained in the previous period. The breakdown would require not only a substantial repair bill, but also a halt in production that would lead to lost sales. Therefore, managers should look at any variance that is significant. The flexible budget variance for direct material is 13,000 unfavorable. This slide presents additional data concerning direct material, including standards discussed in the previous section. The standard cost for direct material is $1.75. The efficiency standard is 1 pound of paraffin per batch of crayons. Actual amounts of paraffin purchased and unit and used is 65,000 pounds, and the actual cost for direct material is 104,000. So let's take a look how both cost variance and efficiency variance cause the total variance in terms of direct material. First, let's look at the cost variance. The flexible budget variance for direct material is 13,000 unfavorable. Using the additional information, we can determine that the company paid less than expected for paraffin. The actual cost per pound of paraffin is only $1.60. Using the formula, the direct labor variance is 9,750 cents, which is favorable. The direct material cost variance is favorable because purchasing department paid less than the standard cost for paraffin. Well, this is the favorable parts of cost variance. But in total, it is unfavorable. So the next part, the second part that would attribute to the total unfavorable cost is efficiency variance. So let's use this formula to calculate the efficiency variance. The variance of efficiency is unfavorable because the workers used more direct materials than planned. Only for 52,000 batches of crayons. So let's look at the material. We use actual quantity minus standard quantity. We use the difference times the standard cost. Here we get direct material efficiency variance, which is $22,750, which is unfavorable. Well, remember this amount. Unfavorable plus this amount, favorable, of $9,750. These two amounts adds up together, we get the previous unfavorable of 13,000. Well, this is how we calculate how we analyze this unfavorable 13,000 in terms of direct material. And again, let me explain this for another time. This variance in direct material, this unfavorable variance in terms of direct material should be attributed to two factors. One factor is direct material cost variance, and the second factor is direct material efficiency variance. The formula in this slide is used to calculate direct material cost variance, which is a favorable number. And the formula in this slide is used to calculate direct material efficiency variance, which is an unfavorable number. And we add up these two numbers together, we get the total variance in terms of direct material. All right. This is the summary of the variance in terms of direct material. Okay, next, let's see the variance in terms of direct labor. The company uses a similar approach to analyze direct labor flexible budget variance. The flexible budget variance for direct labor is 10,400 favorable. And this slide shows additional data concerning direct labor, including standards discussed in the previous section. Direct labor cost standard is $12 per direct labor hour. Direct labor efficiency standard is 25 cents direct labor hour per batch of crayons. Actual amount of direct labor hour is 10,400 direct labor hours, and actual cost of direct labor is $145,600. Again, I said similar approach. The variance, direct labor variance, should be attributed to two factors. First, cost variance. Okay? The 20,800 direct labor cost variance is unfavorable because the company paid workers $2 more per hour than budgeted. The actual cost for direct labor hour per direct labor cost is $14 instead of the standard, which is $12. So we use the difference between actual unit cost minus the standard unit cost. In other words, 14 minus 12 times actual total quantity, which is 10,400 direct labor hours. We get an unfavorable number, which is $20,800. Unfavorable. Well, in terms of efficiency, it is greater than the cost variance, and it is favorable. The direct labor efficiency variance is favorable because labor works fewer hours than budgeted to produce 52,000 batches. We use this formula: actual quantity minus standard quantity, and we use the difference to times the standard cost. We get a favorable $31,200. Well, this is the summary for how the company divides 10,400 favorable direct labor flexible budget variance into its cost and efficiency. Well, this is the end of this class, and thank you for your attendance.